Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50-year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast-track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
Good evening, everyone. This is Niyi Adewole, host of the Ekabo Home Financial Freedom Podcast, joined by my co-host,
Nasir Young, and today we are diving deep into what's really moving the Atlanta real estate market. We're breaking it down newsletter style with a little more of a twist and a lot more strategy.
So whether you're an investor, homeowner, or just nosy about the Beltline, West End, and what your neighbor's house is worth, you're in the right place.
So let's kick it off with the numbers that matter. Atlanta homes are currently selling between 97 to 98% of the list price. And so what does that really mean, right? Are people selling only 98% of their home? Well, no, it means homes are selling slightly less than the price it was listed for. And in our case, that's 2 to 3% less. Those client bidding wars are over and have been over for quite some time now.
And I, for one, am happy about that. I can tell you, having bought real estate from 2020 to 2022, I got tired of hearing highest and best from all the realtors, so I'm happy that's disappeared, and buyers are gaining a little bit more power in 2025. It's great if you're looking to invest, and the price to rent ratio is now hovering between 15 and 16, which is really the Goldilocks era. It's not too hot and it's not too cold.
Oh, Nee, come on. You're showing our age with the Goldilocks reference. I mean, I'm pretty sure that just went over several Gen Zers' heads. And it's a shame, right? They do math different. Their nursery rhymes are not the same. I don't know what's going on with this generation. But translating what Nee just said, that means renting your place still makes a ton of sense. And if you're buying to hold, returns are looking solid, especially in neighborhoods buzzing with the Beltline energy and riding the wave of the MARTA expansion. I mean, look, the median sales price is hovering somewhere around $375,000 with a 3% year-over-year bump. So, no, the market is not cooling off. We're just cruising a steady pace right now, you know? And I get it. There's still the question of interest rates. They're floating between 6.7%, 6.8%. Sure, that's affecting affordability. But it's also keeping a lot of the homeowners locked into those golden 3% mortgages. And for investors, that's a win because it's helping us remain in a buyer's market. And what does that do? That provides you a ton of leverage. Prices are being propped up right now by a variable that can shift in your favor over time. Yes, you know it. Love the home, hate the rate.
Come on now. Love the home, date the rate. I love it. And it's one of those things where control what you can control right now. Go out there, get the house, and then as you mentioned, eventually, when those rates come down, you refinance that thing. But now we're going to zoom in on Atlanta's favorite child, the Beltline. The West Side Park is going to be almost twice the size of Piedmont Park when it's done. And for reference, Piedmont Park is 189 acres, while West Side Park is clocking in at 280 acres. Any real estate nearby is already heating up. And if you're buying near the Beltline, especially Holsey Yard, Pont City Market, or Lee and White Corridor, you're not just buying a home, you're buying into a lifestyle, walkability, breweries, biking, and ATL magic, not to mention big equity upside.
You know, speaking of the transformations, let's talk about the West End Mall. It's a $40 million redevelopment deal and affordable housing, green space, retail, and hotel space. I mean, the works. Think Brooklyn meets Atlanta, which with a little less gentrification, of course. The redevelopment project has been already kicked off with phase one and expected to be completed in 2026, just in time for the World Cup. We've all been waiting for this boom when it comes because we know it's coming. And the final phase is going live in 2028. This transformation screams dollars. I mean, it's an amazing addition to the already vibrant area that is the AUC. And for those that do not know, that's the Atlanta University Center, where top talent for academics are meeting the world's needs at record pace. Now, I might be adding a little bit of size to it, right? But no, the AUC is comprised of Spelman University, Morehouse College, and Clark Atlanta University. You can only imagine what the returns are going to look like during the homecoming season.
Come on now. And homecoming season is my favorite time of year. And out here, there is plenty to celebrate when it comes around. But I want to give a shout out to the city leaders for making affordability a part of the blueprint for the build around the Metro of Atlanta. They've already financed 4,500 units through 2022. And by the end of 2030, they want to have 20,000 affordable units added to the city, which is pretty incredible.
You know, a second ago, you mentioned Ponce City Market, and I just wanted to double down on that because they have an amazing culture. Shout outs to Jamestown LP, who designed and managed that space. I just recently went to Ponce, obviously walking on the Beltline, but you have to try this amazing seafood at WH Styles Fish Camp. I know the name of the restaurant could be improved, but I'm pretty sure they spent a crap ton of time curating that menu because the oysters are bomb and the calamari is next level.
I'm adding it to the list, Nas. Don't let me down.
You know, so let's talk about these other investment angles. Our featured listing on Oakland Drive is a 3-bedroom, 2-bath at $275K and projected to pull in about $74,000 a year in SDR income. That's nearly a 20% return on investment.
Listen, when we're looking for typically 15% or greater, 20% is to the moon. So that's pretty incredible. It's basically printing money while guests come out here to enjoy the Atlanta Beltline. You're going to enjoy your own travels, probably in Europe somewhere, with the money that you're making off of this thing. And because you're near Tyler Perry Studios and Mercedes-Benz, the occupancy is going to be high year round.
You know, I'm riding a bit of that wave right now with my short term that's in that same area, so I'm loving every minute of it. But it's not all about short-term plays. You know, the city Section 8 initiatives and senior housing bonds also open doors for long-term passive income, especially if you're tired of Airbnb guest messages at 2 a.m. And trust me, Ekabo Home Rental Management knows all about those 2 a.m. messages and the late checkout requests 10 minutes prior to checkout time and cleaners en route.
You sound like you've been scarred by this experience.
Just a little bit.
Yeah.
You know, and so there's two big things to keep your eyes on: data centers versus housing. The city of Atlanta just hit pauses on more data centers creeping into residential zones, especially near the Beltline and MARTA stations. Mayor Andre Dickens made it clear the priority is people, not servers. And listen, I'm not the one to talk about politics, but this is an amazing power move for Mayor Dickens. Okay, so I might be lying a little bit. I'm definitely the one to talk about politics because, I mean, it drives real estate, especially speaking, you know, about how that drives markets. Don't let me forget. I'm definitely going to have to talk about tariffs later. But anyway, this power move blocks plans that would have dropped massive data facilities right in historic neighborhoods like Adair Park and the West End, which are two places that need more housing, retail, green spaces, and not more concrete boxes. You know, at the same time, MARTA's new I think it's called the BRT line is pushing forward despite some delays, bringing high-speed transit straight from the South Side Trail. I mean, this shift in mobility is huge. It's setting up big wins in communities, you know, right on the Beltline. Bottom line, ATL investing in neighborhoods and making sure tech does not grow the cost of living.
Yeah, and it makes sense, right? And as investors in the Metro of Atlanta, you want to invest where the city is building infrastructure, not just where it's trendy. And so when you talk about some of these areas where they're starting to put the transit, right? So they can bring more people from one area to another to work, that's a good area for probably rentals, right? And when you talk about some of these new initiatives that they're putting forward to prioritize residential zones and have more density, this is a good sign for Atlanta moving forward.
Okay, Niyi, so what's the key takeaways for the audience? What's the need to know?
There's a couple. So first thing is prices are steady. They're not spiking, they're not cratering, but they are steady, and there's opportunity everywhere as we shift to a buyer's market. The next is for our investors specifically. The strategies that are working in 2025 are STRs, as long as you're doing the luxury type of STR and taking it to that next level using designers, things of that nature. Affordable housing, that's always going to be a need. And if you can find a house where you can qualify for Section 8, those things are renting up pretty quickly. And then Beltline adjacent properties that are close to the Beltline or at least on the path of progress, where you can catch up with some of these new developments that are popping up. For buyers, you've got a little bit more power now. Use it. Don't be afraid to use the force that you have right now. There was like a 3-4 year period where you had no power and it was always highest and best. But now you can actually go for those credits. You can submit that offer that may be a little bit lower than you feel comfortable submitting and see what happens. And then for are really everyone listening, watch the West End. Watch Holsey Yard. There's a lot of development happening out that way, from Georgia Power to new mixed-use projects like the West End Mall that you mentioned earlier. Keep an eye on the West End.
Nee, you're bringing up just a tad bit of trauma for me when you talk about those old bidding wars. You know, that's actually how we met. I don't know if you remember. And it was a great experience. I ended up securing the deal I got now, and I'm loving every minute of it. But for all those out there, if you ever need help mapping out your next move, you already know who to call. Ekabo Home Team's got you covered.
Come on now. Be sure to subscribe, comment, like, and share this episode with your team, and visit cabahome.com for more updates. And if you just close with us, don't forget to get your free LA voucher pass for LA Fitness. We will support you there as well.
Yeah, I like to hear that. You know, we're not just about homes. We're about health, wealth, and walking the belt line in style. Okay, so in truth, I never walked the belt line for more than like a half a mile. Those damn Lime scooters just get me every time. I guess I'm still a kid at heart.
Come on now. It's hard to avoid the limes. I've taken it plenty of times as well. We just want to thank everyone for allowing us to join you on your journey to financial freedom. And we're going to catch you on the next Ekabo Home Financial Freedom podcast. Thank you.
Man, so got to talk about those tariffs. What do you think?
Yeah. Now, so it's one where, man, so I didn't fully understand the lengths that our commander in chief wanted to go to with these tariffs. And you saw how the bond market reacted immediately. And I personally didn't believe it was going to, and I didn't understand the correlation about how this was going to potentially raise interest rates. I didn't see that happening until it actually happened. And so I was against it before, but now I'm fully against it. And I don't know that it's going to work. What are your thoughts on the tariffs? You probably know a bit more than me on this piece.
No, I wouldn't say that. I mean, I will say the first thing I thought about was the fact that I think somewhere around like 60 or 70% of our lumber comes from Canada. Raising the tariff definitely is going to have some long-stem effects on building new homes and just making renovations on homes. I mean, we remember that one time when wood skyrocketed, and that was not a fun time for builders. But, I don't know, man. I think I can't say I'm for the tariffs, but I do think it puts us in a unique position. It's just a lot of cards are going to have to fall in play for it to come to fruition. What I think may happen is if these tariffs stall the economy, they're going to have to make a pivot. And so because we're increasing tension between our foreign partners, the only way that you can make a pivot would be some things that you can control. Fortunately for us, the thing that they can control relatively easy, right? You can't just pull a lever and change things. But interest rates. And so there is a possibility that these tariffs can have somewhat of a positive effect and lower interest rates to get the economy moving again with home purchases.
Agreed. And that was kind of the thought heading into this year. It was like, okay, at least interest rates are going to drop a bit and we're going to be able to refinance and maybe go buy houses. Because typically in recessions, housing actually does okay, except for '08, which it was caused by housing. But since then, it's been okay. But the piece that I've been researching and I actually read a couple books on now is what happens with just the money supply and their confidence in the dollar just around the world, right? And that's the piece that's gotten shaky because this trade war came kind of out of nowhere and it came way stronger than anybody thought. And it was kind of blanketed and not really like directed at certain individuals. It's hitting even a lot of our allies. It has shaken the confidence in the dollar. And I think we're at a 3-year low for our valuation against other currencies. And so when you start to see that, us being a global power and having other people want to hold the dollar as a reserve currency is what allows us Americans to enjoy those low interest rates. If the other countries start to dump this, even if it's just to spite us, you start to see the interest rates spike back up. When the tariffs were originally announced, or really when presidency was originally announced, you saw interest rates come down a little bit. I think it got down to like 6.6, something like that. And now it's starting to rise back up. Last week, it was up towards 7 before there was a pause in those tariffs. And so I get nervous about that piece. And the other thing is I read a book called What Happens When Money Fails. Have you heard of this book about Zimbabwe?
I have not, but now that you mentioned Zimbabwe, I'm pretty sure it's going to be a good read.
Yeah, it's a great book. Zimbabwe, when they first got their independence from Britain, had their currency stronger than the euro at certain times. They had so many natural resources. They were exporting everything. People were coming to do business with them. A lot of mismanagement in government allowed for hyperinflation to creep in. And then people lost confidence in their currency because it changed every other day. I'm not saying the US is anywhere near that, but when you see what's happening with people losing confidence in the dollar around the world, it starts to make your borrowing costs go higher and devalue what you have at home.
Yeah, man, I think you're hitting on some key things here. For starters, a small plug. This is the time where you should serve your country, because if things get a little out of hand, we're going to need some help.
This is true.
But taking a step back, I think there is some inroads there where you have to consider how the dollar looks globally. And, you hit the nail on the head that our market doesn't seem that attractive or safe anymore, right? And so when you compare us to, other stock exchanges, the one thing that America had was that it was a safe investment. And now, sure, every stock market fluctuates, right? But it was pretty confident that over time, you are going to make some money in the American stock market. Now, when you compare that to like China, they have increased amount of volatility. And so we're seeing the same thing right now, but worse. And so, I am curious to see how things play out over time with the exchange. But I mean, only time will tell.
This is true. And the one thing that I would question with you, and it's one I've been thinking about, we haven't had a real recession since like '08, because like it's hard to count the pandemic because everybody went through that and it shot down and then it went crazy. And so I think it kind of overcompensated for it. But at least in my adult working life, I haven't been through a recession. Would you say that we're overdue for one? Do you think we're going to head into one? Are we in one right now? What are your thoughts on the recession piece?
So there are some scholars that believe in order for an economy to truly recorrect, it have to go through a significant downturn. And so thank you, Obama, for what you did to stabilize the economy and keep us going. But there are scholars that believe that giving the banks the bailout put us into a long-term crash course that could have significant impacts over time. Look, I can't say I'm smart enough to either agree or disagree, but it is interesting to think that we are still dealing with things that have happened years prior. And so, do I agree with the way Trump has handled things? I can't necessarily say that I do. But I can say what he's doing is something that should have happened a very long time ago to course correct. It's just he's taking big swings when I think we should have been taking some more pointed approaches.
And I would agree with that. And I appreciate how expertly you navigated that tough subject between Democrat, Republican, but actually getting to where we're trying to get to, which is how do we stay on course and actually make our future better than our past? And so I'm with you. I think what he's trying to do, right, is take some of the spending out and actually get us to have a budget, right? It's like you can't just keep spending and trying to increase how much, because I mean, look at it, right? I'm going to butcher these numbers because I didn't look at it beforehand. For the '08 crisis, I think we spent, maybe $1 trillion or maybe a little bit less than that, like in the 900 or 800 billion range to kind of bail some banks out and things of that nature. During the pandemic, only a decade later, we're spending 3-4 trillion, right, in printing. And so it's showing you how less the dollar's being valued at, even just a decade later. And after reading this book on hyperinflation, I get nervous about that. The only real way to start to combat that is to have some pain in the market, as you mentioned. You've really got to pull back. You've got to start cutting some of the spending. The piece that I think you mentioned that makes a lot of sense is you don't want to come with a sledgehammer and do it because you don't know what you're going to break. And so within the first 90 days, we've had all these cuts and it's like, dude, this is too fast. Market's going up and down. You gotta slow it down a little bit. But I get it. I get the overall goal.
Yeah, man. Trump is President Trump is very much a bull in a china shop.
Yeah. Yeah.
Now, hey, look, to each his own. But time will tell. I will say the one key thing I think, at least how I'm posturing in this market, is I think it is a safe bet to double down on affordable housing. Look, President Trump can do a lot of things. What I don't think he's willing to take a big swing at is pulling back the Section 8, the voucher program. And so what does that actually mean, right? Well, if you structure your deal well enough where you're purchasing long-term rentals in low-income housing communities, you could set yourself up to at least hedge the downturn. right? Because the government, it just has to stabilize that community, and so it's going to cut the checks. Now, if he decides to pull those checks with Doge, then don't say you got your advice from me. But
yeah, listen, we will give you his contact info in the show notes. Don't hit up me. That was Nasir. All right, Nasir, for the record.
But look, man, that's my only strategy to hedge this downturn. I mean, the other thing, too, is trying to build up my coffers, right? So try and build up enough equity where when the market turns, I have some liquidity to go in and make some strategic decisions. Yeah, 100%. But, and you know, it's tough, too, right? Because I am not against finding good deals and paying at this interest rate. Because like we said before, there is a lot of leverage on the buyer side because homes are getting on market and just sitting.
Nas, you hit it spot on. And when you talk about real estate in general, through most recessions that aren't caused by real estate, it actually performs well. This is one of those assets that goes up and to the right over time, as many of you know, and especially when you combine that with the risk of inflation continuing to heat up, because that's what tariffs do as well. They spike inflation. There's already risk of that continuing to go back up. And so when you look at being able to get a property that will cover itself and just hang on to it, I think that's a major win coming through this turn. But when you talk about make sure you're building up reserves, I think that's a huge point that needs to get repeated. You need to have like cash on the sideline. This is not 2020, 2021, where everything's going up 20% a year, where you just want to get it all in the market. You do want to have something on the sideline, and we can all take a lesson from the page of one of the greatest investors ever, Warren Buffett, who before this whole drop, and I think before the presidency, had $330 billion on the sideline. I'm looking forward to seeing him come back in and buy something too, because you know he's not going to stay on the sideline forever.
Man, you brought up Warren Buffett, and I think about this dude in terms of his investment strategy all the time. It's like he has a pulse on the markets that no one else has or ever has had. And it's mind-boggling. You know, at some point, he's had to have had so many stocks and been able to model things so many times where he can see certain triggers, whether it be from the political side or certain downturns in the economy, where he can kind of see some things shaping out and make some key decisions. Or he's got an inside man that's just phenomenal.
Yep. And that guy hasn't given him up in all these years, just like Charlie Munger. Either that or maybe he's just following the Reddit profiles, man. Once people start talking about, I'm going to be an investor, he's like, hold up, that person has no idea, and he's pulling his money.
Yeah, man. I don't know how he does it. All I can speak to is real estate.
Yeah. Hey, and real estate is where 90% of millionaires first got their million, and so it's a great asset to be in. The other piece that this has made me start to actually research and look into, I was doing it already, like dollar cost averaging in there, but now I'm actually like, okay, this could be a viable thing. Bitcoin, like it's highly controversial. There's a lot of people that are like, hey, no. There's other people that swear by it. And for me, when I look at how currencies can be manipulated, right? The US dollar, how hyperinflation can affect that over time. It's one where I want to continue dollar cost averaging there just to see what happens. Because if we do shift over to a model like that, especially now that we don't even carry cash in hand, it's all digital anyway, I'd be interested to see how high that goes. But what are your thoughts on crypto and all that?
Man, listen, you are going down a lane. I probably should spend more time researching it. I really should, because there are some gains that can be made there. I am willing to take a lot of risk. Bitcoin is just one of the ones I always stay away from.
That's fair. That is fair. One of my guys, and it's one of those where you got to know yourself, right? One of my guys who invested in Atlanta for a while, now he's doing all his investments in Washington where he lives. He was heavy into Bitcoin. He was doing like, I forget what you call it, like options where you put down 1/10 of it. What do you call that? Where you put down 1/10 and you don't have to put the whole amount?
Yeah, you're talking options trading.
Okay, right? Options. Yeah. He was doing options for that. I think he was doing it when it was at, I don't know, like 40K. And it went up to like 50 or 60 and he's living great. And then at a certain point, like 2 years ago, it crashed down to 30. And it was around then when he sold most of that because he couldn't hold the water. Had he held it till now, it's 100K. But like you really got to be in it super long term, at least from what I've seen. I'm not putting a lot. It's not like, hey, this is going to be my future here. I'm putting maybe like, just a small percentage, 2%, 3% over their dollar cost averaging.
Yeah, man, for sure. I am not opposed to doing, casino betting with Bitcoin. And so for those that don't know, casino betting for me means I go to the table or go into the casino that night with the amount of money I am willing to spend, right? And I'll sit down at the table. If I go up, every time I go up, I start partitioning money that a part of that allotment back into my pocket. And then if I'm up, I play with the money I'm up on for the rest of the night. And so if that's the model for Bitcoin, so be it. It's funny we got on the topic of Bitcoin. I have several friends that has made thousands of dollars, and for a very small few that have made millions. Shout out to Howard. Howard University, that is.
Yeah.
But no, man, it's money to be made. It's just for me. I don't know heads or tails, right? There is no, and maybe I just don't know enough about it, but I can't make a calculated decision. It's kind of just riding the coattails. And so, yeah, if I knew more, then I would consider it at least at scale where I can try and make a little more off of it. But like I said, I guess that's just the risk I'm not willing.
Hey, come on now. And that is fair. To that point, majority of my investing is all in real estate, which we study every day. Same with Warren Buffett. He's definitely not in Bitcoin because he studies the stock market and companies every single day. So that's where he focuses in investments. And if you are able to become an expert at something, whatever that is, whether it's stocks, whether it's real estate, whether it's Bitcoin, become an expert, and that in and of itself helps lower your risk. That's the key.
Now, I will say, in this vein of investing, I am curious how emerging markets are going to shape out. I think there is some interest there with trying to identify where some of these foreign countries can potentially come in and find their niche to make an upside. And so that is where I'm going to start taking a bit of my research to try and figure out where I can make some inroads there. And then the other part, keeping a pulse on these Fortune 500 companies to see who's making the big shifts to come back at scale to America. In that same vein, shout outs to Ford. In this moment when President Trump decided to double down on his tariff agenda, Ford decided, hey, look, can we make gains? Sure, right? But can we decrease the gains to be more profitable? And so they're taking a chance, right? So they've lowered the cost of their cars to a price that would be comparable to how much they would charge their employees to buy a car. And so I don't know where they're sitting with this next release. I'm curious to see where their quarterly reports are going to be at. But the rumor mill is that they've actually seen an increase in sales.
Wow. So I didn't even know that news about Ford. Shout out to Ford as well. That's amazing to lower the price when we know that your costs are probably going up a little bit. And I saw a commercial, I think yesterday during the game, where Ford was saying that they manufacture the most cars in the US already. Am I spot on with that?
I'm not 100% sure, but I'm loving that energy, right? Double down in this time with having a value proposition to the American public. Make people want to reinvest into you. I give kudos to Warren Buffett, who recently posted that he was excited to pay as much as he paid in taxes this year. That's walking into the room and making a statement for sure.
Oh yeah. And part of the reason he was excited is because he didn't lose it all in the market when it all went down later this year. So he's excited, but he was smart too. And I was having a conversation with one of my former managers at Baxter literally earlier today, and we were talking about this piece. And the thing that I don't know is actually going to happen. So they're trying to bring manufacturing jobs back to the US, right? And have people start working it and things of that nature. I don't know about you, but I don't know many millennials or Gen Zers or the generation after that want to work in factories. It's just not a thing anymore, right? It's literally not a thing. People want to be influencers. People want to go and things of that nature. And so even if these jobs return, who's going to actually work it is one, the question. And the other thing is AI is getting more and more powerful, right? By the end of this decade, more than likely, we're going to be able to replace a lot of these factory jobs anyway with robots, right? That are pretty smart. And if I'm a company, one of these Fortune 500s trying to bring manufacturing back to the US while still keeping costs down, that's probably the way they're going to be looking anyway. If McDonald's and Chipotle can bring in these robots that can chop things and make it easier, why not do that for cars?
Yeah, man. 100%. But I'm going to take off the politically correct response for 2 seconds, and just say, my opinion is Americans are, by and large, man, we're getting soft. Like, I don't know how else to describe it. Look, I was in the military for 8 years, and about 6 years out of the 8, I spent the bulk of my time in the field, right? And so, for everybody that doesn't know, being in the field, it sucks depending on what time of year it is, either too hot or too cold. And so that's, somewhat similar to what you would expect in a warehouse. Either it's too hot or too cold. I think suck it up, right? Like, and here's the thing. Here's why I say suck it up. When you look at how America was postured back when we were a manufacturing boomtown, yeah, going to work sometimes sucked. Yeah, a lot of the times it sucked. But the country was seeing significant gains and the wealth gap was not so spread, right? And so we need to see a portion of that come back. Now, granted, we'll never see the amount of manufacturing that we've seen once upon a time. It's just, with the amount of technology, it's just never going to happen. But if I were a company and I was bringing back a percentage of my companies to America, manufacturing to America, I would make a strategic play to go to low-income communities. And so this would be the time where I would have my lobbyers focusing on trying to create policy around me creating these manufacturing plants or whatever I'm bringing back in low-income communities. Because the reality of it is, if you're going to get wrench turners and get them fast, those are the people that are going to do it. And you get to help the community by getting them some dollars in their pockets. Create different incentive programs for them to reinvest into your company and buying your product. And then what you do at the same time is there's some synergies there because you build the know, like, and trust, right? That factor starts to spread across the community because, I'm buying your product and I work here. So now we're taking pride in these things. It's no different than, quiet as kept, I don't know if most people know, but the black community bailed out Cadillac, right? Cadillac was a failing company. And then it turned on the black community to buy Cadillac. And then Cadillac became a prosperous luxury car manufacturer. And so I do think there's possibilities to get back into these low-income communities and make some inroads.
Yep, and it also helps when you have a Ludacris track that's stuck in everybody's head talking about the Cadillac grills. But anyway, but one thing I would say is, and I'm with you, right? I hear you on that piece. And even one of the synergies I thought about while you were talking about this is, what if you did what they do on Google campuses, which is build housing, affordable housing that, hey, maybe this is the incentive. Because the piece you're going to compete with is there's a lot more ways to make money now that does not require you standing on your feet the whole day. Like, you can go drive Uber. So it's a question of how much can you pay at these factory jobs? Are you paying more than Mickey D's or something else where I could do on the side while building something else? That's the piece I struggle with. Plus, back in the day, what made it, and not even that long ago, like even the medical device company I was working with, the reason I joined that company is because they had people that were celebrating 30, 40, 45, 50 years with that company. Now, looking back, I understand why. It's because up until 2012, they were offering a pension, right? And so a lot of the people that even retired right around the time that I left were still getting their pension and getting paid, 60% of what they made in their best 5 years for the rest of their life. And so the factories used to do that before and take care of you. But I mean, you found out after people live longer and longer that that's just not, it's just like Social Security. It's not going to be around when we need it, right? And so I don't know how you get back to that. That pension was a major driver for people saying, hey, it's going to suck right now, but it's going to be great in the future. It's almost the reason that you take some of these government jobs. Like, hey, 20 years in, I'm pension, I'm good. I don't know how you get around that.
Yeah, man. It's going to take a lot of powerful minds to come up with ways to be strategic in these markets. And, you hit on a lot of pieces. Just because I have somewhat of a squirrel mentality, I'm going to go for the one that caught my attention first.
Please.
Which was Uber. Man, look, every time I get in a car and take that Uber ride, I always tell them, I say, hey, how much money are you making on this ride? Because I'm going to tell you how much I paid. So you need, as a driver. Listen, man, as a driver, you need to know these things. And I challenge these drivers to start being vocal about it. Because the reality is the platform does not work if there are not drivers to drive, right? And so, yeah, there's going to be people that need a ride, but they're going to have to figure out another way if there are not drivers. And so Uber is in a unique position because I think when they first released, the splits were somewhere around 60 to 70 the driver's way, and then the other 30 to 40 went to Uber. And so now they have teased out the elasticity of their pricing on both sides, right? And so they're running regressions on how low can I take this number for the driver and how high can I take this price for the person that's requesting the ride. And so it is very often that I will take a ride and pay somewhere around $30, $27 to $30, and my driver's making $7 to $8, right? And they're never going to be able to put two and two together until they open their mouths, right? And so this is the economy we're in, where people are being very sophisticated at structuring business practice, right? And so we have to have a little ownership as the business owners and start putting things back in favor of the person, right? And that's not vocally, people are going to say, that's what we do, right? But like, are they really doing it behind the scenes, man? And that's the challenging part. You know, I don't like industries that don't put the client first. And that's just the brass tacks, man. Call me not meant for the business world. I don't know, but you know, I'm the type of person where like, I want the business owner to treat me how I would treat the person if I was on the other side.
And that is spot on. That's also how you retain and kind of keep people, right? And you get those people that are doing like 5-star drives and things of that nature, where now everybody's experience is great with Uber, which helps you retain business and people don't look at Lyft, right? And so I've definitely felt the increase on the customer side. Every time I go to the airport now, it's like, dang, man, this used to be $20. Now it's like 40. Like, what happened there? But to your point, it is a difficult thing, right? And I think that especially nowadays, you really have to try to take it into your own hands, as you mentioned before, right? Because that wealth gap is getting wider and wider. And so you have to find other ways that you can maybe put a side hustle together or build out a business that really makes sense for you to kind of go from there.
Yeah, man, 100%. Which I know I've said it a million times already, but that is exactly why I double down in real estate.
Come on now. Hey, same here. And Nas, anything else top of mind before we wrap for the night?
No, man. I'm just, you know, while we are in a bit of, I guess we can call it the start of an economic downturn, I think there are still ways to stabilize your investments and hedge against what could be, I guess, impending. I just would say stay optimistic, keep your ears to the ground, and utilize platforms like this and other platforms with people that are talking about investing, because that's really the only way you can really hedge about it. Try and absorb yourself with as much information as possible, so when the time comes, you can make a strategic and calculated decision.
Nas, you are spot on with that. We are going to end there with those wise words, and also invite you to go ahead and like, subscribe, and follow, and send this to some of your friends and family. As we continue to build this market update out, we're going to be coming back more often to let you know what's happening around Georgia and the metro of Atlanta, to help not only our investor clients, but those that are considering it. And even if you're considering moving down here, I think this is going to be a lot of value to you. One other piece that we will mention is we're going to be having an Ekabo home event on May 17th. It's going to be exciting. We're going to have our whole network there. Last year, I think we brought in about 50 people or so to network together, talk about real estate, talk about the market, and really make meaningful impact. And so we look forward to seeing you there. Until then, we bid everybody adieu. Have an awesome night.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.